Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
Hey, greetings everyone, and thank you so much for joining us. It is Macro to Micro Options Power Hour. I'm Samantha LaDuc, founder of LaDucTrading.com, joined by Hans Albrecht, our options mentor extraordinaire on the West Coast. I'm Boston, and we come together every Wednesday at 4 o'clock, market close, talk market direction, market structure. We throw in some macro. I might even taunt with a little bit of intermarket or fundamental analysis. But for the most part, we're talking trade setups, and we also answer your questions. It is an ask us anything type of format. Just be very specific on your trend, swing, or chase time frame. In other words, is this something that you have a commitment for, long or short, and what duration? That really helps us out a lot. So basically, we're coming together here on finally a balmy summer feel post taking the weekend off, which is to say, I exited on Friday afternoon and came back Tuesday morning, and we had our quintessential birthday rally on Monday. So it always, if you look historically, I don't know why, we have a rally on May 12th pretty much every single year. And this one was a doozy. So we got some nice trade war de-escalation out of Geneva, which had probably been in the works for the past few weeks. And anyway, resolved itself into this very hopeful backdrop of US reducing Chinese tariffs down to 30% from 145 or 80 or whatever. But remember, they already have 19% in existence under Trump 1.0 back in 2017. So we're not really out of the woods yet. This is still very chaotic, especially for small, medium-sized companies to try and plan around supply chain drama. And it is only a 90-day reprieve. So we had one that came in, the infamous April 9th. We caught actually live intraday, which was very sweet. But when Trump said he was going to delay basically the rest of world tariffs for 90 days, so those will trigger on July 8th, I believe. And this latest round, which is very focused on China, is a delay of 90 days, which will trigger about August 10th. Ironically, we have some macro event risk around that same time frame, which is this tax cut and debt ceiling lift, which is required right now for the market to kind of be very hopeful moving forward as it relates to DC. But they're having a really tough time getting this through. You've got some diehards that want some deficit cuts, and that is not what this bill is about. This is absolutely extension of the Biden tax relief and also the Trump tax cuts extended. And it's an increase of 1.5 trillion over the next few years. So it's definitely a reason why bonds cannot catch a bid and yields stay very firm. So anyway, we got a macro event risk coming up in that bill, but it's not a defined date. And then we have the trade tariffs, basically relief rally, and we've had a heck of a rally. So long story short, we went into and through my VIX 20 target, which was basically my tell that we could stay long, and we went right through it. So we crashed right into the 18 handle, and we could even go into 17, 16. That's what I want to talk with Hans about, since you are a study of all things VIX, and also your option positions have been just doing extremely well in the Bitcoin realm, in the tech realm, because we had this very strong growth rally. How long can this go, Hans? Inquiring minds want to know.
Well, we've been talking about this. Hello, everybody. Hi, Samantha. So yeah, it's just been flinches, right? The flinches heard around the world, one after another. And so I think what the weekend did is it really pulled forward some of the remaining uncertainty. You mentioned some uncertainty around July and August, and for sure, those are going to be issues. Right now, that is not top of mind for the market. What is top of mind is really that the crisis of confidence, the growth scare, some of those really big issues, the existential risk, as I called it a few weeks ago, is off the table, right? And so it wasn't really anything that broke the economy. What's so interesting about it, nothing really broke. The financial system didn't break. It wasn't something in the economy that went bad that sort of compelled the market to react to it. It was something that was an intentional we call it an own goal. And I don't know if they use that in soccer, but in hockey, it's an own goal. You scored on your own net and you shocked people. You broke confidence. It was very abrupt. Not in the sense that tariffs weren't expected. We knew that Trump had talked about tariffs, but it was the level of aggression, the sort of almost radical, thoughtless manner in which they were suddenly being used. Every country targeted and all these crazy numbers, 145%, and we're not even taking phone calls. Don't even call us. We're not interested. It was really shock. And I mentioned, even on our show about a month ago, I said, maybe there's a chance that this is paralysis. So we saw confidence fall off a cliff, businesses, consumers, everybody. And I said, it wasn't anything actually actually to do with, at that point, or at any point in the near future, it wasn't anything to do with people not being able to continue spending. The economy was generally okay until all this happened. And so it was this shock and paralysis that was brought into the situation. And so it was this kind of, and it's interesting, somebody who was talking about it, I think it was Tom Lee talking about if you polled Democrats versus Republicans, right? So there's sort of these, of course, all these things. The market was reacting from a Democrat standpoint. This is horrible.
He's going to say anything to talk his book, and you know it.
Yes, that's true. Like Yardeni at least will dial it back a little bit. Kind of funny seeing those guys.
Really. A bunch of folks dialed it back. Yardeni was very cautious. All of a sudden, he was not pricing in any recession risk at the beginning of the year. A big soapbox I stood on was, hey, nobody's pricing this in. They're going to be in trouble. And then BlackRock actually said we were in a recession just 3 weeks ago. And Apollo increased the recession odds to 90% starting this summer. All this did right now was push it out. So this stagflation risk has to be ratcheted down a little bit because they pushed it out. The recession risk also has to be pushed out. Doesn't mean that tariffs are going to go away and they're not going to be disruptive to supply chains and to the labor market, but it has been pushed out. The growth scare has been pushed out. And we're going to talk about the mechanical buying that's part of this, not as much fundamental buying. We have talked about this every single week. Mechanical buying, these are CTAs, these vol strategies, not to mention just good old-fashioned price insensitive quants, and they have been in the house. And then we got some hedges that really had to unwind after this gap up on Sunday night futures. We can't really just go with a particular sentiment narrative that fits. There's a lot of buying that happened underneath the surface. That was one of the reasons why we were bearish VIX and bullish the market into this level.
And so absolutely, we ran it down to 5,500, then we called up to 5,750, and then we called it down to 5,000. So there was a time to be bearish, and then we have these mechanical things. So it really is very mechanical. If you look at the sentiment, this is almost the most unbelieved, hated rally. You'd almost have to put it at the top of the list over the decades because nobody's really in. You look at these sentiment indicators, everybody's going, what happened here? I didn't have a chance to get back in. And that could lend some fuel to the upside, at least a bid. I told somebody this morning, I said, I don't know if we soar, but we have this bid for people who just been sitting on the sidelines. And you mentioned Apollo. He loves to be a bear. Stock loves to be, a bull rather. He loves to be a bull.
I was going to say, what?
He loves to be a bull. And it was just an about face in so many ways. And now it's funny, like dominoes, they're pushing everything up again.
Well, he did preface this. He does see a 30% chance still. So he didn't unwind all of that bet. And more importantly, we still have a mercurial president as it relates to these tape bombs. And we still have fiscal dominance, which I cannot underestimate as it relates to rising yields. And we have, even when I came in Tuesday morning, I'm like, hey, look at the 10-year and the 30-year. We're right back almost from this infamous April 8 bond crash, where the 10-year had a very fast spike from 3.9 to 4.5. That was a rate of change that actually interrupted some think basis trade. It was reported in Wall Street Journal or one of them, Reuters, that it was actually swap trades that got out of control. But the point was, you do not go from 3.9 in the 10-year to 4.5 in 3.5, 4 days without breaking stuff. And that's what froze the credit markets and liquidity. Equities also froze, right? They needed to come in the next day and calm bond and equity holders to stop selling. And that's exactly what they did. And we had that 10% intraday reversal. But I don't think this is a safe bet. And I'm commenting on one of the questions in here that we have seen the lows. I absolutely don't. This is almost a reflexive rally you can size up. When we saw the VIX finally break on April 22nd, anyway, when it got back below a very key level, which happened to be strangely 19, when we got up 30, what was it? We did this live. Anyway, it was a really key level. And I'm like, okay, so now we can fade into OPEX just like we did in March. So we faded into that March OPEX, then we ran VIX back up, and then we faded back down into April. So we can do this again. In fact, I think we'll have another opportunity in July. But to answer your question as it relates to the George Noble podcast, yes, I absolutely think we're going to roll back over into Q3 and we will revisit not just the 48.78, but I think we'll take that out So 4,800 is really strong support, but it would not surprise me if we take that out and go all the way down to 4,000, depending on how recession risk really starts to fashion itself. Because remember, at the beginning of the year, they had zero recession risk priced in. We're all the way back up, nearly a few percentage points away.
Yeah.
But has anything changed? Is there a real big growth narrative to get us moving higher with higher tariffs and still uncertainty and supply chain risk and recession risk? And now we've got household getting crunched and delinquencies going higher. So now we have to focus after this gamma squeeze on the real economy. I definitely don't think we're out of the woods, but I think this is a very nice opportunity to reset shorts into the end of the year.
Percent of credit card balances that are taking longer to that are paying, the percent of credit card balances that are not paying the minimum payments. Yes, certain things go. That's never really mattered that much to the market. I know at some point it does have to matter. There are the Walmarts.
It's the aggregate of macro data that comes together.
Eventually. But right now it's an unwinding of the sort of irreparable damage that 4,900 entailed, which was we are just tossing the global economy into a dark, deep pit. And so now you have Trump going, okay, look at Nvidia. He's suddenly the Trump that everybody knows and loves and wanted for the stock market. He's making deals with the Saudis. Now, oh, don't worry about it. You can't sell chips to China, but you can sell a whole bunch to the Saudis.
Yeah, so this is not a comfortable thing, by the way. He's just doing a deal with the devil, but it is absolutely a headline that bids up Nvidia. Now, luckily, this is when you're talking about Nvidia. This was had gorgeous. I had these $10 increments. We're going to go from 96 to 106. We got to work that out. 106 to 116. That's the next $10 phase higher. I keep talking about this all the time. We've got to get above 116 to make it into 126. And now that 126 to 136, which was my high call into Nvidia earnings for the 28th of May, it's going to be there a lot faster than because of what's happened this weekend. But normally it's a grind. We grind up into that next level, and then earnings for Nvidia, granted, they're going to make their numbers because they've got an AI modified chip for China. They're doing backdoor deals with Malaysia to get to China, which, by the way, I have written about for clients. It's unprecedented billions. Their sales in the US are completely flat in 2024 and starting to fall, but they now have Saudi Arabia opportunities and funds, and AMD is benefiting from it as well. And AMD not only is doing a deal with Nvidia, with the Saudis, but also a $6 billion buyback that they announced today. So of course, semis are getting the bid. The growth rotation is fully in view until it isn't, until the next macro trigger interrupts the bullish flows. It could be a yen carry trade unwind. It could be a basis trade unwind. It could be rising yields. We already have rising real yields. This bill that they're trying to pass is an absolute nightmare for Main Street. It is absolutely benefiting Wall Street. So as much as they talk about it, it's watch what they do, not what they say. So we are not out of the woods as it relates to falling dollar. I don't mean this week. I'm talking big picture. And that also hides the damage that's going on because it's falling and it makes equities look higher, which is exactly trapping the bulls. And we've been here before. We're not going to learn our lesson. We're going to do it again. But anyway, I think this is still, the road is definitely not clear path for higher. I absolutely see reaching up into that right shoulder on a head and shoulder and rolling over into the end of the year still.
Oh, well, that's fascinating. So, well, we're going to get our chance, right? We've got the VIX down into the 17s. I think to your question earlier, I think we could get into the 15s. I think there's some unwinding. I'm looking at this and saying, well, okay, like I said last week, we're always, as volatility traders, we're always kind of looking for what's that next shoe to drop. And if it isn't going to drop for the next couple of weeks, then there's some opportunities in the meantime, and you want to set up for that particular eventuality. So what is it going to be? For now, it's just crushing the volatility. People expecting that. Look at this, seeing so many fund managers being offside. This is the market of offsidedness. So many people are not in here. Look at the Russell was just massively shorted. So people are back into that, which I don't think is necessarily a fantastic investment. You can see it's playing out in so many places where people thought this is going to, remember, there were some studies going around, well, the average negotiation takes 6 to 8 or 9, 10 months or whatever it is. And then boom, in one weekend, it's done. So it's really, it's a shock to the upside as much as it was to the downside and for the markets, from the market's perspective. So that I think it can take a little bit of time to play out because so many people are not involved and maybe start to look at this and go, boy, this is going to be a tough year if I don't, if I perform about half as well as the index. So we'll have to see how that kind of plays out over time. I think AI is full speed ahead. I think it's a good sign that AI is starting to lead things up because we saw MAG really suffering for quite a while there. Microsoft's all-time highs again. I did not see that happening. I thought it would hit 350, but I did not think it would rally $100 after that. So pretty amazing stuff out of there. I've got a long Nvidia call, long Google put play. My Google put is getting crushed. It is not cooperating with me right now, even though I've turned sour on Google because of its search situation, but the Nvidia call is making up for it much more. So positioning in some things like that, and you were talking about some other trades, there's some interesting long vol trades, right? So there's some, especially in the Bitcoin area, as I keep saying over and over, I think there's some interesting spots. We've got Bitcoin topping out. Either it's going to go or it's going to fail again. And I think there's some cheap options in there. I'm looking at skew on a few things as well, even like little weird things like Celsius, where you've got flat upside skew, very low implied volatility. That sets us up for interesting strategies like back spreads and to be able to.
You mean, correct?
Yeah, well, in some
Yes.
little names, but in VIX, look, VIX is back to that structure that is a little bit more challenging for those kinds of trades, a little bit more positive for the SVIXs, the SVXYs. So from a perspective that it's weird because just as one thing is sorting itself out, another one is starting to hurt those products. So yes, the VIX has come down from 50 to 20 or 19, but at the same time, the structure, that roll yield structure is hurting the short VIX products right now. So what they need is a really something very worrisome to get back to, the point where we're going to get those long vol trades doing well again. Right now, they don't have that sort of pull of gravity that they had for weeks and weeks. They were very reactive to sell-off. Right now, they won't be as reactive. Having said that, we have some interesting opportunities. We're seeing that downside skew. So we've been talking about this for a couple of weeks. They are ignoring the upside and focusing fully on the downside. That downside put skew, everybody was buying puts like there was no tomorrow and completely forgetting about that upside. That has played out. So we're seeing that regulate a little bit.
Yes,
meaning
we needed that 57.50. It was critical. I said once we get above 57.50, it will move very quickly higher. What I didn't know was we were going to gap up Sunday night, and I think we hit whatever it is. Anyway, we're up 200 points, right, from the Friday close. So it did not even tag 57.50. It gapped above that and just went Monday, Tuesday. That's actually a really good level to short against. So once we stop, and right now I still have my intermarket, it's bouncing into resistance was the title a few weeks ago. And then it was bouncing in the resistance part 2 because it's still bouncing. And then it's bouncing into resistance part 3. We're still bouncing. So now we actually got above, right, that key level, that shock and awe as far as the growth rotation, but it's not really. VIX crashed below 20. So if you're looking for a nice level to go short the market, wait until VIX gets back above 20, because that's the level where I see it creating more pressure on the downside. In the meantime, we're probably going to go fake breakout, fast failure, or we're just going to grind sideways for a while until we get a macro event risk. And honestly, we've got a bunch of them that we could look forward to, but I don't have any dates in particular. I just know that's what we have right now is a macro event risk that needs to interrupt the bullish flows. We have the bullish flows right now. If you're looking for a level to short against, the Qs need to get back below 503, and the SPX needs to get back below 57.50, and VIX needs to get back above 20. Your guardrails or a swag as it relates to when to get aggressively short the market again.
Yeah, and Richard is asking, well, how can the VIX be so low if we're looking to a future of more volatility? Well, remember, Richard, the VIX is very short-term oriented, not super short-term, right? There's a VIX 9-day for that, but the VIX is 30 days. So it's looking between, forget what it is, 23 and 36 days or something like that. There's a window. So there's this wait, let's hurry up and wait thing, right, with VIX, which is in the short term, everybody's thinking there's going to be a little bit of a bid in here as a lot of people go, whoops, didn't expect that to happen last weekend. And so they need to reallocate. And then some of the other things that we've been talking about, which is many of those mechanical things, the vol targeting funds, they've reallocated a little bit, but they're basically done for now, except for some of the other ones that some of them look at 1 month volatility, which has been crushed, right? We've dropped all those big days from early April out of it. So they've reallocated somewhat. Now we've got the 3-month vol that's still hanging in there. That's the interesting thing about those products is they can't do anything. Even though we saw the market rallying and implied volatility, meaning option pricing coming down, that realized volatility was just staying up high because it was incorporating those massive days of movement from early
But
April.
outliers do revert with velocity, and
Outliers.
we did get a nice reversal. I just wanted to share something real quick because I
Yes.
literally just posted this. You're talking about the big news, right, on Sunday that caused the gap up. Even before that, I love this quote here by Goldman. It says, if everyone is so bearish because they were tracking 11 weeks of negative bearish sentiment, which really was a record, right? People are fundamentally justified to be worried under this particular regime change, political, monetary, fiscal, everything. But the point is, he said, Goldman said, systematic community has purchased 100 billion of global equities in the last 10 days. This was something I grabbed on Friday, by the way. And then Nomura chimed in, past 2 weeks have seen a grand total of 118 billion of buy flows across the leveraged ETF rebalancing, which you follow very closely, and the options dealer hedging flows. It was the largest 2-week buy impulse we have seen in at least the past year. So those are the mechanical flows that we started talking about a few weeks ago. Literally was the title of my May 5th trading room recap. It feels wrong to be long, and yet, and we talk about this, option flow and dealer positioning. Also, Spot Gamma gave us some really good insights that a lot of it was put covering. But the point is that they were coming in to buy, long story short. And it was really the price insensitive flow, mechanical buy. People then, like Tom Lee, go, oh, really? It was just oversold sentiment. No, really, it was mechanical buying. Look, McElligott again, Goldman again. The point is, it was very much a deal where we just needed also a positive peace deal, trade deal, tax cut deal, whatever, to make this rally really get going and focus on that 57.50 as wall where hedges, and we talked about this, would start to go, oh, wait a minute, maybe we're going to go back to all-time highs. I better unwind this or roll it out or what have you. And that's what really triggered the short covering. And the macro trend trade, we're going to have stagflation and we're going to have a growth scare and we're going to have a recession risk, had to be unwound all at the same time. So that was a magnificent 200-point advance we basically did in a few days. But that doesn't mean they can't come back in. It's just the game that is played with market structure of who's actually buying. Now we need organic buyers, not gamma chasers. We do not need that. We need organic buyers.
You're right. It's all artificial. It's all artificial at this point. Not many people are really buying this market. But if it stays up here, they could be compelled to start buying the market. It creates a little bit of a bid. You still have CTA profiles, buy a little bit down, buy a little bit up, buy sideways. So there's still a little bit of that mechanical buying in place a little bit. So there is this kind of wait and see. Is something going to happen? Is something new going to happen? Are we going to get some? I think the market's kind of thinking, well, we're going to get some deals. And so I was saying last week or even a couple of weeks ago as well that, look, I think at some point we're going to get to the point where, and I see people on CNBC talking about, well, we're going to get this slowdown from all this pull forward purchasing, all this, there's going to be growth. Who cares? The market doesn't care about that. The market's very capable of saying, I think this is transitory. I think we're going to get through this. Let's look to next year and tax cuts and things like tax benefits, et cetera. So the market's very capable of looking past something that people may be focusing on a little bit too much. But the fact that we got this news this past weekend pulls forward some of those positive vibes, because now you've got this deal that might have taken months. Then we're going to have, presumably by the time we see slowdown, we're probably going to see more pull forward because we got 90 more days now to stock up on items, on Chinese toilet paper or whatever people are buying. And so now we have the chance to even create more of a kind of almost a bit of a shell game in the economy where people are like, look, the economy, the numbers are really good, but they're only good because of what's happening out there. So by the time that the issue of a slowdown comes around, then maybe we are in a position where there are lots of deals have been done and Trump is becoming friends with everyone again in the stock market. So for now, Greg's wondering, you have the spot up, vol up, you have this sort of pushing down of downside, but you've pushed up call side again, right? They overdid it. They crushed that upper call skew, and now they pushed it up a little bit again lately because they got that wrong. We will see that get pushed down again, I think. If we persist up, we're going to see dealers get replenished. So all these cover call funds, everyone's going to come in and start hammering that vol. That's going to create a bit of a richer gamma profile, which all that means is that it should reduce volatility even more. So that is really, the VIX isn't looking at the move we had on Monday warrants a 30 VIX, but the VIX is saying, don't care. What I see is that this is a completely different situation, and there may be a bid to the market for some time. So people do not want to overpay for options at the moment. That doesn't mean as hedgers, we can't start looking to July, for example, as a way to start picking up some of those hedges that have come down in price. That is our opportunity. If you want to hold equities, you really should have some protection for it.
And if you watch that 10-year yield continue to percolate above 4.5 on its way to 4.76, you get above that 10-year 4.76 and stick that landing, it'll be too late for hedges. I'm telling you right now, it'll be too late for hedges. We'll be off in the 4.8 and it will be running higher, and it will be a serious run higher, and inflation will start to take over as the narrative, not liquidity. Do you remember this chart that I gave? Also, let me just show this because this was a fabulous tell that I have talked about, also shown this. I show it to clients all the time, but I'm talking about occasionally I'll poke it up right here on the screen. Liquidity matters to market returns right now, full stop. It has since 2009 when they came in and did all that policy intervention, and they've been coming in ever since. Stealth QE, actual QE, doesn't matter. Well, I have this handy dandy little E-mini futures right here, and it also corresponds with Fed balance sheet. And I have it on a 2-hour chart just because I really watch this every day. Long story short, when we did our talk and I said, VIX is coming down into May options expiration, and it just needs to break this level, and then we can head down into 25 and then 20. Same time that VIX did start to break that key level, which was on April 22nd, we had liquidity come back up and cross my line in the sand, which is it went from negative to positive. Ta-da! And guess what else happened? The M-minis started to grind higher. What was the price target I gave? Exactly tagged yesterday, 5928.25. So this is literally one of the targets that I gave a few weeks ago, and it's because of liquidity. And the reason why I harp on this is because once the 10-year starts to get up to the 4.8, liquidity won't help us anymore. This will not be a guide. I have to go and use something else because VIX will start to get really busy. Equities will start to get a big headwind. The dollar will continue to fall. People will be very confused about that as yields move higher. Gold will pick back up again. And that liquidity tell that I just showed you won't work. So I'm serious about this. This is not the same market we had.
If you had to look at one thing, Samantha, is that it? Is it the 10-year yield? What is the one number that matters? Full stop.
Full stop. Okay. I use it as a rate differential as well with my dollar yen. I use it against my intermarket analysis. There's no question. I use it against liquidity tells, which I have a few. That's not the only one that I use. But as it relates to dollar falling, yields rising, that is still my baseline bet for this year. And right now we're in this kind of Goldilocks zone of we're coming off the euphoria of the Trump trade deal. If it actually comes to fruition, and him in front of MBS and shaking hands with all kinds of dubious characters, it's the stake of the devil got together and had a party, and they invited all of us in, and some of us went, and I'm back here going, don't do it. So I don't trust it, long story short, but it is money, and the market is responding to liquidity and the promise of liquidity. But I'm just telling you, if this 10-year gets and stays above 4.8, it will no longer be about liquidity. It'll be about inflation. And then the market will lose this traction of, they've got all kinds of money coming in. No, the money actually makes the inflation worse. Anyway, we'll do this on another time. But the point is, that's my story. I'm sticking with it.
I think the market can handle a certain amount of inflation. It can handle a certain amount of higher rates, but what it can't handle is the growth scare. So I think what we've taken off that big growth scare, and so that's for now, people are employed. I think that could change at some point, but for now, it's a little bit more, we're closer to the porridge is warm than everything's boiling over. So it's from the market's perspective, things are okay. So now we're going to wait and see again on the inflation numbers. I think AI is going to be incredibly deflationary at some point. Somebody's asking, Leo's asking about Nvidia. I feel like the horse is out of the barn here. So I know, Samantha, you've been calling for higher numbers. I think we could
136. That's all. I had 136 from 96, and that was for Nvidia earnings, which are on the 28th. After that, I'm not so excited. I'll be honest. I'm really not that excited. I think it's going to form a right shoulder of a head and shoulders top, and therefore I'm not excited about this going into higher realms even though the Saudis have come out and said they're going to buy a whole bunch of this and that and the other thing.
Yeah, well, you know what? Thank you for that, because I'm going to start hedging. I'm a little late to this party. I have to admit, I started to get constructive again around 117 last week. And I said, you know what? I'm starting to get a little bit more excited about AI. It's been tossed aside for about 8 or 9 months. And I really do believe there's going to be this insatiable appetite for these GPUs. We always talk about it. Oh, so-and-so needed hundreds of thousands more GPUs than they imagined. It's just, I don't think it's necessarily going to slow down, because I think there's a lot of pressure out there to keep up with the Joneses in the world of AI. And I don't see it slowing down. So that's the one I like. AMD's done well, Broadcom's done well. They've all been doing fine. Semiconductors are up,
these are
45%.
great. These are great swing trades too, from a standpoint of Marvell and Micron and AMD coming down into their 400 week. And I have this mantra that clients know in my live trading room. If you have a stock that comes down to its 400 week, UNH is an exception, by the way, and I see a question in there about UNH. Usually it bases there and starts to move higher unless it's dead in the water. Like there's a big major problem with it. UNH is a big major problem. But the point is, all of those have had beautiful bounces. Nvidia, by the way, never saw its 400 week. It's still the poster child for semis, the golden child, I should say. But the point is, AMD, Marvell, Micron, if you don't think they're going to go away, these are great places to sell puts or expect a bounce of some fashion. But it doesn't mean it can't digest there for a good part of the year. So anyway, the point is, I know it seems very exciting to still get on the bandwagon with AI after a growth scare has abated. But what if I'm still expecting another growth scare?
Do you have to have a but? Can't you just get on board? Why don't we need Tom Lee to get on here one week and give you a dose of, listen, everything's fine. Yardeni's calling for the roaring 20s coming back, and it's S&P 10,000 by, what is it? I don't know, 2028, 29, 30.
I know. And Goldman updated their forecast. Not only did they remove recession, but they said we're going to be at 5,900, which is, by the way, where we are, okay, in the next 3 months. We're going to be at 6,500 within a year. Come on. They'll just ratchet that down. The first sign of jobless claims spiking, the first sign of trade deals unraveling, the first sign of yen carry trade or basis trade unwind. It's just the games. They're always late to the party, and we're the party makers. So
that's right. Yeah, they're the flip-floppers. They're flip-floppers, but a lot of people watch them, right? So a lot of people pay attention, and it's a gamification of Wall Street a little bit going on there, right? They want to be able to say, well, we sold that. What do you mean? We sold that. Yeah, you sold it on the lows. Yeah, but we got out of it. So there's a lot of the visibility thing on Wall Street that they just need to get things right at some point. Doesn't matter when they got it right. They can say, we changed our mind. Look, we changed our mind right here. So we always take what they say with a grain of salt. We are dealing with markets on a day-to-day basis as traders. So I think some interesting things. I've been playing upside in Tesla, and I don't know how many times I saw it rally. I bought it in the low 200s, and it rallied to 290, came all the way back down, probably twice. And I said, my goodness, I should have sold. But I'm hanging on because I believe in this as my main moonshot. And I think the options have gotten quite cheap. I added a turbo trade on it for August the other day. It's already doing very well as it's jumped through 300. I think it can get to around 360. Ultimately, I think we maybe see those highs again. And then MSTR, I took off.
I know you love that MSTR. You did great on that.
I love playing it. It's just, there's so much movement in it. I messed up a little bit when it dropped to 250. I could have really monetized that move on a long strangle that I had.
So do you ever do just directional calls and puts, or do you always have some fancy advanced option where you're buying and selling and basically managing, because you can weave in and out of all of those legs? But I'm just talking generally. Do you ever have like just a high conviction, it's going to go here, and I'm going to buy a call, and I'm right or wrong? Just curious.
Absolutely. No, I absolutely do. And to be honest, I'll tell you right now that I find some of the more fancy strategies. So if you want to call a butterfly fancy, an upside broken wing butterfly, I've been doing some of those, did very well on one of those on Meta recently, and on Goldman Sachs, sold the Goldman Sachs too early. Well, on the Meta as well. But did very well, 100%, 110, 140% on those. But you see those big numbers, 140%, fantastic. But you have to keep in mind that these kinds of trades are ones that you can't necessarily allocate a lot of money to, right? It's all relative for people's account. But if somebody has a $100,000 account, you're not going to put very much into one of these kinds of trades, because you could lose the full debit for that particular trade if you're wrong on it, and maybe you can get out.
I don't have a problem with the credit, with the debits. That's actually defined risk. It's the credits where you have to manage it a lot more closely. And there are different types
Yeah.
of traders. Chase, swing, and trend, I call them. The trend folks that just look at their portfolio once a month. Swing, they're more active traders and investors. And then those momentum players, which I got a whole bunch of them in my live trading room. They'll chase anything that moves. But you fall somewhere in the middle because you trade everything from leaps to all of a sudden you're chasing momentum. So it's just interesting how you
Everything.
are definitely organized in your trades.
Well, and that's what you have to drill down into what are my bigger allocations and what are my smaller ones. So the flies are fun trades. You can make 200, 300, 400%, or if you're just long a call, you can make a few $100, but you're not going to put $100,000 into something like that unless you got boatloads of money. So you have to silo the strategies. For example, our finance plays that we do sometimes and things, that's something you can really lean into. You can put a large allocation into something like that, because if it's a trade where the worst case scenario is you end up owning a stock that you really love at a price that's even better than where it is now, then that's something that's okay. Your worst case scenario is you own a good stock. Your worst case scenario, if you pay $10 for a debit spread, is you lose the full $10. So you always have to allocate appropriately for these strategies and figure out, like I made 140% on this meta upside broken wing fly, and I was very satisfied and proud of myself. But if I'd done a couple other things, I would have on an actual absolute basis, I would have made a lot more money with other kinds of strategies. But I can only allocate a certain amount to something like that. So you have to really think about options trading in that way as well, that there are certain ways to really move the needle in your account. So
Go ahead.
Yeah, I was just going to say, to your point, MSTR is a great example of something where I did, in fact, and so let me show you this. I did, in fact, look at a trade maybe about a month ago, and I was looking at the MSTR vol, and I'm not always talking about how cheap it is. So I said, I'm going to buy some upside. And I looked at that upside skew, and I said, it was about 300 and the 350s. That upside skew, meaning those calls weren't very expensive compared to what they normally are, right? And MSTR, usually they're pushing up those calls, those way out of the money calls, because of that upside explosive potential. Everybody thinks Bitcoin's going to go to 1 million, right? So they push it up, but they've really compressed it over the last month and a half or so until recently. It's starting to normalize a little bit. So that was my chance to say, well, look, I think when I might look at something like the implied vol percentile or implied vol rank, and that's going to give me an idea of, okay, well, where are we within the range over the last 52 weeks? Am I low? Am I middle? Am I high? We've happened to be quite very low. We've had days recently where MSTR options were in the 3rd percentile, so really cheap. And so that's where I go, you know what? I don't think the opportunity is in selling a credit spread here. I feel that there's bigger fish to fry, right? So I got into this position to the upside. It ran from 3 to 350. Then I said, well, okay, now I've done well, but I still believe in the upside. So I sold a 400. So in all, I put in $9 and I took out 33. So that's fun. So to your point, sometimes I will lean into a position with just a long call or maybe just a long put. But when it happens, I won't necessarily just take it off, because I may still believe in an extension of that move, but I want to neutralize some of my risk at that point, right? I've got too much risk. I've made a bunch of money, so I want to take some delta off, or I might want to take some vega off, which means that maybe the vol has gone up and now I've done really well, so I want to take some of that off. So I sell some of those upside calls that hopefully have steepened and are more expensive on a relative basis. So the way that you manage these positions can change a little bit depending if you're watching the Greeks and depending on your viewpoint.
You got a question on here. Speaking of options, we'll go through chat and Q&A. We're getting hit with both sides, so let's go through about this. Okay, so first, I'm random all over the place. Question for options on Tesla. Why would one buy 720 puts when the price right now is obviously a lot less for September 25 on Tesla? So I'm assuming you see an unusual option activity, maybe of size. I'm not looking at it right now, but this is a question by Jay Gill for very out of the money put.
Or very in the money? Are they calls?
Very in the money, sorry, very in the money put in September. What's your thought on why they would do that?
Why would one buy the 720 puts? I mean, unless you've sold them somewhere and you're buying them back, it's difficult to say whether they're buying them or selling them. I can't see any big reason why, if you wanted to get short Tesla in a sort of limited risk way, that's not really the greatest way to do it, because you're putting a heck of a lot of money into something like that. If somebody sold it, maybe it's a kind of weird sort of synthetic covered call, right? When you sell an in the money put, it's like basically being long the stock and short the call.
It's an odd one, isn't it?
It's a very odd one. Yeah.
Yeah.
I'm not sure, maybe.
Yeah, and I'm I'm familiar with selling deep in the money calls and puts when you have the underlying, but as a hedge, otherwise that's a really odd one. But yes, Andrew, to your question, strangles, covered calls, condors. Oh my goodness, yes. So we have a wonderful trading desk of 10. Some are directional, but Archna, Hans, and Mike are very much focused on these advanced options, and they're doing, the most advanced I do is really financed call spreads and put spreads. I'm very particular about my option tactics. I happen to really adore those for high conviction. So I put those on with high conviction. I know how to manage it. It's all your comfort level, but I'm not doing income trading. And I know, Hans, you also, and Archna, she also has just an income portfolio that you're managing, which is great for range bound. I'm always focused on market direction, sector rotation for volatility, explosion in stocks, mostly swing to trend timeframes, but also setting up chases. But I really don't do so much of that, but you guys do. So that's a benefit. And yes, there is an artistry of doing options, but it's all what you're used to and what you're comfortable with, and you teach it. So obviously we've got options education for beginning, intermediate, and advanced. And then aside from those courses, working with clients wherever they may be, whether they manage a book for other people and manage other people's money, which is what Hans did in his management of portfolios for hedge funds for years and years, overlay strategies, or just placing his trades. They might be directional or managing VIX options in a hedging strategy, but teaching it and also playing options, this is what we primarily do. So in regards to that option play, then what is this? Renewed bullish?
Strangles and condors. Yeah, for sure.
Yeah.
I had a strangle on MSTR. There it is, the usual suspect. And that did very well. In fact, that was the one I mentioned I messed up because I put it on, I leaned long. The way that I like those strangles is I like a directional play. Well, it is directional, but I like to lean in one direction, right? I don't just place it neutral, meaning way out of the money call or way out of the money put. I go, you know what? I think there's movement because I think where some people get the long options game wrong is they think that a move could happen, but a key element to being long options where you're behind the 8 ball a little bit much of the time because options tend to be more expensive, right? If the VIX is 16, the realized volatility is actually 14, right? So options tend to be a little bit more expensive. That's a feature of options market, generally speaking, let's say 85% of the time. So when you play the long options game, you really want to give yourself a head start in that game by having a number of things. Number one, you want to make sure that implied volatility is very low. If you're not as sure about a move, or you think it could be happening, make sure at the very least that you're buying a very low percentile implied volatility. Or that's not always the case. If you have existing momentum, if you have big movement already underway, then you give yourself license to pay up a little bit because now you're getting something that's very important to you. You're getting the market telling you that there's momentum in a particular direction. Another thing that I see people do wrong is they catch the falling knife. They're buying calls even though a stock is plunging. Why are you doing that? The market is telling you it is going the opposite way. We are not good enough
Well,
to
that's going to
bet
lead
against
into
the market.
UNH. That's going to lead. Okay,
That's
speaking of catching a falling knife, I actually wrote this that UNH has surprised me, which is to say it didn't just break huge expansion bars on the downside with more selling. It barely stopped at the 400 week, which I told you is really critical for me as it relates to big important stocks that you don't expect to go away. So dropping 50% and going through the 400 week, we're talking, it blew that out below great financial crisis type of rate of change downdraft. So 50% in less than a month is a big deal. Usually I only see that in a case of fraud or where there's concentration risk unwind. So fraud, we haven't heard of anything. We know about the CEO who was killed, and we know about the new CEO, which was really old, but he stepped back. Anyway, and then we know about no guidance for 2025, and we know about all the fiscal stuff that's going on in healthcare and RFK Jr. and all that change. But this is different. 50% in a month for a major holding from sovereign hedge funds to pensions to a hedge fund hotel is extremely unusual, not at all usual. So I've only seen that in two cases, really. Number one is when there is a case of fraud, And maybe there are insiders that know it's coming, or they sell first and ask questions later, but nothing has been announced at that level. Or when there are insiders who are in trouble and they are forced to sell. So my mantra about money goes home, money can rotate, right? Money leaves. There's no question we had a huge exodus out of the dollar, out of US equities, out of bonds. Bonds are still weak. And we've had the mechanical rotation back into equities, which I think will also show its face in the next few months, where there'll be selling under the surface, which will then in the future create an air pocket of risk, which will then catch a downdraft. But we're not there yet. But yeah, that is very unusual for UNH, where even the 400-week didn't slow it down. Monthly support didn't slow it down. Something's wrong.
Something's wrong, right?
Yeah, 300 is probably a good area to catch the knife, but I think I'll wait. I think I'm just going to wait until it kind of bases and shows that it's worth doing something with. I don't think there's any reason to jump into it. And then the comment about continued dumping of TLT by Japan and the spending bill passing in its current form that adds $4 trillion to the deficit, et cetera, et cetera. Yeah, bonds are a bad bet. So I know that there are reasons why folks will clip coupons. It's 5%, whatever, on the 10-year. But I think a much better place to go long-term bonds is when the yield curve, the 10 and 2-year yield curve, has stopped steepening. Now, right now, we're in a temporary little flattener since April, May, because of what's been going on with recession risk and the bond market crash and all that stuff. But I think it's going to start to steepen again. And once we start to rise up, I have a particular level where I think it's going to be safe to buy longer duration bonds. Or if by miracle we get the fiscal spending under control and a balanced budget, what are Vegas odds? So anyway, and then to answer the other question, next target for Nvidia, it has been increments of 10. Look, 96, 106, 116 was critical. I keep talking about 116. It's, oh my goodness, it's a year and a half. It has just been 116. So it's got to get and stay above 116 to move to 126, 136 by earnings. And then sure, if we do have a blowout in earnings, although I'm not expecting it, then we can have something that, I'll say maybe 146 as an outlier, but I really don't think so. So that's all I got for, there are better choices right now than betting on 146 Nvidia, in my humble opinion.
Condor, yeah. Somebody's asked about condors. I think they're okay. They've been difficult. They were difficult in April because the realized volatility, so actual movement, was just outpacing option pricing. Now that we've come down the other way, probably could make sense. I wouldn't be afraid of doing maybe like a 6-7 day condor sort of thing. Some people are doing 0 DTEs, not really my thing. You want to maybe come in and make sure things are stable by 10:30, and then some people like to do them then. But condors, to me, I think not bad. I think if we get a little bit of a pullback and maybe a VIX 19 or 20, I think they could be interesting again for a few weeks, because I like condors when vol's a little bit higher. Some people like them for the theta. They're really good for the vega exposure, where the vol is going to come down again and you can capture that with a condor. So I don't mind them. I haven't done any lately just because I know there's one group that does the 0 DTE condors and they just got completely slaughtered in April. And there's a time and a place for them. And I think you could do okay on them for a little while here.
In your question, it's very funny. You, Richard, asked what might push the 10-year bonds to 4.8%. And right above it, you may not be able to say, right below it, it says, Andrew says, the interest on the debt alone could cause a bankruptcy or a sovereign debt default where they don't pay their foreign debt. That's actually the big deal, right? The reason we have a trade deficit is because we owe 61 trillion. It's off balance because we consume so much from others. But the point is, yes, that is the trigger that I have, Andrew, for inflation that is very hard to control. So Richard, basically Andrew answers your question right after saying interest on the debt because of this fiscal spending that's out of control and inflation that could become, again, I know there's the debate about a deflation impulse if prices start to crash, but right now we would go back into prices rising into an economic contraction if this trade war really starts to pick up heat. And I don't think any of that is priced in. And then over here on T, you say, why am I alone on this thesis? June 14th, birthday parade. He's not letting tariffs, market volatility, or inflation headlines rain on his taxpayer-funded celebration. Then he pivots, goes to other countries, hammers Congress on extending his tax cuts, aka his legacy loan. That's true. And let Besant shift the market toward lower growth end bonds just in time for the looming $7 trillion debt wall. It's true. It's really nerve-wracking. But you, T, who says 6.5 is your target, that no, we'll be cooked. That's not okay. It would have been okay in prior iterations without this deficit situation. Monetary regime has switched now to fiscal dominance and all that jazz and debt on interest. And the point is, now we have a different backdrop. So tariffs are how they're forcing US to consume less abroad and how they're incentivizing US companies to do business here. But that's a transition period, and they're not giving us any time for transition. Yes, Jason is not in my daily trading room, but he has his own from Voland, he's a guest contributor in our Slack member workspace. Love his insights also. He's very much focused on Vanna and all the directional, which I like, swing targets. So when he is bullish and bearish, it's not for the day. I don't do even though I do a trading room, it's to chase Tesla in or something like that. And then anything else that I missed? Will we go down to 4,000? For me, it's a high probability we retest 4,800. If we take that out, we go down to 4,000, and that the dollar would fall while yields are rising. In the meantime, that's not right here. As it relates to diversification, Asia has a lot better consistency, believe it or not, than Latin America. So right now, all that drive of money that has rotated into the EU, both the euro, that's dangerous to me. I don't see how they're going to escape recession. We have really seen that China, Malaysia, other countries, even with it's better. I know that's not what mainstream wants you to believe, but we're very fortunate that we have Jeffrey Fouvray, who is on our trading desk, who is an expert in emerging markets. He's in Brazil. He's a Frenchman in Brazil who trades mostly Asia because it's so incredibly oversold, undervalued, and phenomenal prospects. So he's much, much more focused on Asia, Southeast Asia in a nutshell. And then what else? Hans, thoughts? You're adding VIX call ratio spreads. This is from T under in Q&A. If you check there, Hans, targeting tariff pause dates, buyback, blackout, quarter end, OPEX. Quarter end is also very volatile. Quarter ends are almost always very volatile. Okay, so he's got a
okay. VIX
Okay,
call ratio spreads. You mean 1x2s? Oh yeah, 1x2s. Yeah, it's okay. Be careful with those, just because.
That's right. I
I
asked
see
about
those.
this very trade.
Yeah. You have to understand, like, you can do VIX trades for alpha, which is looking for maybe a little bit of a measured move, and that could work as a hedge to a portfolio. It's not really going to be that great because you either think things get ugly or they don't, and then you don't really want to be that short that extra call. So it depends. I'm not saying it's a bad trade, because you do get that the ratio can work because that upside call skew is very steep. So you're playing that a little bit, that compression. And then maybe what can happen is that 28 just gets cheap enough, you buy it back. Now you're long the 20 for a really nice price. So that's possible. I like a ratio. If you're going to try to thread the needle and say, well, I'm going to put on the ratio because I don't think things happen for 2 weeks, and then maybe the short calls come down a little bit and you buy them back, and now you've got it on. Maybe something like that. It depends on your purpose, on the purpose for it.
I just noticed we did our hour, but we definitely, we bounced around. Any closing thoughts you've got, Hans? I am really just focused on the fact that we gapped above some very important levels. And if we start to see, and I haven't seen it yet, okay, right now we're overbought. Now we need to process that overboughtness before I can actually start to see selling underneath the futures. It is brand spanking new that we just gapped above 57.50. So as far as I'm concerned, it's bullish above, bearish below, and we can actually do some chopping about into June. I wouldn't be surprised after this Friday when we have 90% are calls. They expire, they're off the board. That's when we can have some shake and bake. Shake and bake is just another expression for a pullback, short duration. It probably gets bid, but the point is, I think we're going to have a lot more choppiness now that we've gone into these higher levels, and those are the key things I'm looking for. I don't think we have a solid short until VIX gets back above 20. And right now it's still falling.
Yeah, it is. I think that continues. I think they're going to buy every little kind of small dip, just because I think, for all the reasons I've been talking about, I just think that people need to get back involved in equities to some extent. So we'll see. There's been talk for a couple of weeks of that, the May OPEX. After that, then we'll be free to roam about the cabin again. So we may get a little bit of more market movement. My gut is, I keep saying this, I'm going to be wrong one day, but I've been saying this for a while. The pain point still seems to be a little bit up. I don't think 6,100 6100 or 6200, but I think we could drift up towards that nice round number. And so I'm interested in maybe some calendars to play like a steady little rise up into that level, but it's going to be like little movements, right? We're back to the part of the market where it's like little kind of fine tuning trades as opposed to looking for those ridiculous moves that we had for a few weeks there. So it's really just getting your mindset into what this market is. It's not a market to push things around and force things. Just play for those small wins, and then we'll see. It's going to pick a direction at some point, but I feel like it might still be just a little bit up.
Okay, this is one thing I want to just real quick go over, which is gold.
Yeah, good question. Great question, because I've been
think
watching it.
Okay, so we got to do this. All right, so this is the 2-hour chart. And before I left, there was this kind of theme, right, of dollar would make its way back up into the 102.5 handle, and gold would start to rotate lower, and that would help equities. So that has definitely played out. But there is a chart, and I know we've talked about this as well. Hold on. With gold coming back down into, I'm going to show you GLD and then continuous contract, and I'm going to show you a big intermarket chart that I really like. This is GLD. So you can see where we got extremely extended, and it just so happened it was a gorgeous continuous contract on April 22nd. Remember, it was live in the room. We actually talked about this on Wednesday, the following, because it hit 34.99, not quite 3,500. And I had already set this up short. Archon jumped on it right away. Anyway, point is, it made a double top. It has been softening, and the rotation out of gold into equities has really helped the bid in equities. Remember, this was the most crowded trade, and I showed you that chart a few weeks ago. But the one that I wanted to show you was this. That
was a nice lower high there, Samantha. That was a nice lower high. That next day down would have been a great shorting opportunity after that lower high.
So what I wanted to show was on that gold, if I can bring it up, it's okay. That's not, hold on, give me a second. Okay, so this is the one I wanted to show you. This is continuous contract. Okay, so we also did this live. This was the April 22nd. And the reason why it's so important is because on April 22nd, not only did I call the gold top, but I also said VIX would fall into this May options expiration, and that rotation out of gold and softening of VIX would help support the market. So that really worked. It also timed perfectly with that liquidity tell that I showed you, the one that popped up on April 23rd above my yellow line in the sand. So I have all kinds of things that I'm using. It's not just one model. But the point is, this is your double top. And I remember T saw that like last week when we did this, and he said, oh my God, it's a double top. It's gorgeous. And it's still coming back down into support. Remember, it hit almost 3,500, and it's coming back into this trend line. But this is the chart I wanted to show you that matters a lot for trend traders. And they're the ones I care about because I've got clients that are ridiculously long gold and silver on a trend basis, and then they work with options to protect around. And I'm not just talking physical, but also miners as well as paper. This is monthly. Windows are open. We got some allergies here, but hopefully you can hear me okay. This is the silver gold ratio, my particular spin on it. This is coming back down this month, and we're coming back down to the mean. So for trend traders, anything in keeping with this mean is gorgeous, which happened to break out last March 1st, 2024. Problem is that it looks like more selling is coming to a theater near you, which means this month could be weak, could continue to be weak. Not just what I showed you on a 2-hour chart, not just what I showed you on a double top continuous contract, but I'm talking about this is also rotation into equities. So this is that macro trade. We gotta go get gold because trade wars, and countries are settling more with each other in gold versus in dollar or in the petrodollar. So just be careful if you are trend or swing long. Miners are coming in, gold is coming in, silver is very slow to come in, but it's still important macro trend, but it is right now in distribution. So take care, protect your gold and miner longs. They have done a lot of heavy lifting. Let this market calm down. I'm talking equities, and then you'll be able to go back into gold. That's my bet. But right now it's in distribution. Hope that helps. I hope everyone got something out of today. Come back next Wednesday, 4 o'clock, same time. And thank you so much for joining.
Thanks, everyone. Go Leafs.
Cheers. Bye.
Bye-bye.
Subscribe to LaDuc Trading YouTube channel for more macro to micro options power hour and other content.